Hello everyone, I'm Ganesh Patlagari. Today we're going to discuss about our week one training discussion. So let's get into our agenda. Number one, brief summary of major concepts found in chapter one and chapter two from financial and managerial accounting information for discussion. And number two, what is trial balance and what is its purpose? Number three, what is the balance sheet derived from the trial balance? Summary of major concepts I found from the chapter one and chapter two. So let's see. Financial statements as primary information sources. So, like these financial statements serve as a crucial sources of information for decision making in businesses. And balance sheets, income statements, and cash flow statements provide a comprehensive overview of a company financial health, performance, and liquidity. By analyzing these statements, stakeholders can access the financial position of a company and make informed decisions. Number two, the relevance of financial ratios for analysis. So, this second major finding emphasizes the significance of financial ratios in analyzing and interpreting financial information. Financial ratios such as liquidity ratios, profitability ratios, and solvency ratios offer valuable insights into various aspects of a company financial performance. Number three, financial information discussion making implications. So, so in this one, the direct implications of financial information on a discussion making process within organizations, like by leveraging the insights derived from the financial statements and stakeholders. Ratios and stakeholders can make strategic decisions related to investments, financing, budgeting, and operational planning. For example, like liquidity ratios can guide decisions on managing cash flow and working capital. So number four, the function of financial information in business success. So uh, it plays like a critical role that financial information plays in driving business success. Effective utilization of financial statements, ratios, and analysis tools enables stakeholders to make informed decisions that align with the company's goals and objectives. And let's talk about the trial balance. So, what is trial balance? Trial balance is a summary of all the accounts in the company. It it lists all the debits and credits to ensure that total up approximately to equal it. It's like making sure everything is good within the accounts. So let's talk about what is the purpose of trial balance. Simple, like the primary goal of a trial balance is to check that the accounting records are correct and balanced. Like it allows identify problems and in the financial statements. Like if the debits equal to the credits, that means the the balance is like good order. It's in the good order. So let's talk about one example. So we can see in the table we have accounts, debits, and credits. Always the debits from comes in the left side. So cash. Let's see, we have cash for 500. That's debit. Supplies. So supplies comes under debit, 200. So sales revenue, that is credit, 750. So rent expenses, that is 100. It's debit. Loans payable, it's 50. So when we do the total, let's see, 500 plus 200 plus 100 equals to 800. Let's see the credit side. 750 sales revenue plus loans payable 50 equals to 800, which means this trail balance, this table is good with everything. So how is the balance sheet derived from the trail balance? Uh, let's discuss about that. So the balance sheet is like categorizing the accounts into assets, liabilities, and equity sections. Assets are on one side, and liabilities and equity are listed on the other side. The total assets must be equal to the total liabilities and equity, ensuring that the accounting equation, like assets equal to liabilities plus equity. So now let's talk about the assets. So assets are like resources that a company owns and controls that economic values can be used to generate future economic benefits. So like typically cash, accounts receivable like inventory, etc. And liabilities. So liabilities are like uh, that the company owns to external parties such as suppliers, lenders, or creditors. Like liabilities represents the company's debits or financial obligations that must be like settled in the future. Like liabilities are typically categorized into like current liabilities. Like let's take example of long-term loans or bonds payable, etc. And last but not the least, owner's equity. Like owner's equity represents the owner's claim on the company's assets after deducting the liabilities. It is the difference between the company's total assets and the total liabilities, and represents the owner's investment in the business. Owner's equity can be further broken down into contributed capital, like for example, common stocks, bonds, etc. So these are my references, and